we don't finance, so thank God it's an issue that we don't really have. But even if we did, because we're a core buyer, I can only say that it wouldn't be an issue to get a financing. But, and that's what I was saying earlier, the liquidity of the markets, just off the beaten track, what everybody's looking for at the moment, that's the product that isn't finding finance that easier, or the player who owns it doesn't want to commit 45 or 50% equity in order to get that finance. So obviously your equity margin is going to increase the more you move away from core. That hits your returns. It kind of it doesn't make it an attractive investment. The turnarounds aren't going to come. So that divide is continuously growing in my perception. So there's going to be a continued pressure on an outward yield shift in those locations if banks don't start going into that as well, or the added value or core plus investors will accept lower yields, essentially. It's one of the two. You need a stable market. The markets work, but it's one of those. It's a trade-off of one of those two positions in order for those markets to become liquid and active again. And really, it's a very split market, and it's a very difficult one to move in, because if you sell in those markets, for us, for example, you tell your investment board, look, the pricing, we've got to cut down the price, and we aren't finding a buyer. Next day, you present an investment opportunity, and you're at the lowest yield you've presented in the last 24 months. So it's a difficult one to cover, and hence why I think that's the difficulty. Why new product, turnarounds, refurbs, added value prospects have a good chance if you find a way of finding a bank to share that risk with you. And I think there's enough demand to buy it, because you need to put core type assets back on the market because everybody's looking for it.
Okay.
I think just to add, not to leave you with the impression that only core is being financed. It's not that extreme. That's where most of the competition is. That's where the most interesting margins is. That's where the life insurance or the insurance companies are most active in. The biggest deal last year in Germany were the Twin Towers of Deutsche Bank in Frankfurt. Those were financed by Allianz. That's an easy deal for them. And that's what they concentrate on. They're not going to go into smaller cities and smaller deals. They say, they don't have the expertise. They don't have the risk management capabilities. That's where the local saving banks and even to a certain degree the Landesbanks come into play. And there is financing available for B cities, B locations, because we talked about it originally, growth. Even banks need to grow. They don't, people want to pay dividends. Management wants to get paid. They want to grow their balance sheets. Not everyone is shrinking and day in, day out. So across the board, relatively speaking, the financing environment in Germany is pretty healthy. Not to always talk about the Greeks and the Portuguese, but German banking is not as bad as you would believe if you read the FT every day. It is quite aggressive and quite a competitive environment, and there is enough money for good deals, whether large or small.